Welcome to Aenten. In this deep dive, we're going to talk about bookkeeping basics for beginners, bookkeeping fundamentals, intro to accounting, whatever you want to call it. Bookkeeping is the systematic process of recording, organizing, and managing a company's financial transactions. What does that mean? Let's talk about it. This discussion is going to be perfect if you are trying to start your own bookkeeping business. Or maybe you just want to get a job as a bookkeeper. Or maybe you're an office manager for a business owner and they want you to learn more about bookkeeping. Or finally, maybe you're just a business owner and you want to understand bookkeeping fundamentals and basics. Okay, so let's unpack this. We're diving into the absolute ground floor fundamentals of financial record keeping. For anyone wanting to quickly get a handle on how money actually flows through a business, this is really the essential blueprint. We've basically synthesized what feels like a college lecture, but, made it actionable and free.
And we absolutely have to start with the why. I mean, what's so fascinating here is that bookkeeping it's not just paperwork you do at the end of the year. It is the real-time engine of financial visibility. It's the difference between guessing where you stand and actually knowing.
Knowing where you've been so you can see where you're going.
Precisely. It lets you align your spending with your budget, not just once a year, but every single month.
That visibility is so critical, especially when we start talking about, growth and compliance. If you don't have updated, accurate books, you can't even calculate your true net income.
Which means you have no idea what your tax liability
What's
is.
that?
And just picture an audit for a second. It could be the IRS, a state agency, even an insurance company. They don't want estimates.
No, they want documentation.
They want documentation, receipts, bank transactions, credit card records, all of it neat and organized. Without that bookkeeping, the whole thing just spirals into a nightmare.
But let's flip it from the nightmare scenario to the opportunity. You can only answer those big strategic questions if the data is current.
Like what?
Well, did our revenue actually increase this month? Can we afford to hire that new employee? Should we be cutting our marketing spend? You can't answer that stuff on a hunch.
And don't forget the banks. If you want to grow, if you need a loan or a line of credit,
They want to see your financials.
first thing they ask for. Your tax returns, your profit and loss, your balance sheet. If you haven't been keeping the books, that conversation it stops right there.
And the upside of tracking all this correctly is huge. I mean, the tax efficiency alone.
Oh, absolutely. Every single legitimate business expense is a potential deduction, a tax write-off.
We saw that tracking expenses properly can save a business around 30%.
30%. Just that one fact makes keeping your books up to date one of the highest return activities you can do.
Which brings us to a distinction that I think trips up a lot of beginners.
Bookkeeping versus accounting.
Right. What is the actual difference?
Bookkeeping is the foundation. It's the disciplined work of recording, organizing, and classifying every single transaction. It's the daily, the weekly grind.
So bookkeeping is the data entry, creating the database, basically.
Yep. And the accountant, they take that clean, organized data.
And they do what with it? Just prep taxes?
No, not at all.
Yeah.
That's the higher level work. Interpretation, analysis. The accountant uses the bookkeeper's data to prepare those formal financial statements, analyze trends, and advise on big strategic decisions.
Okay, I like that. So the bookkeeper is the cartographer making the detailed map.
And the accountant's the navigator, using that map to plot the best course.
That framing really helps. Okay, so we need to talk about the systems we use to capture this data because the method dictates the quality of the info, right?
It dictates everything. And the simplest is single entry.
Which is pretty much what it sounds like.
Exactly. One record for each transaction, like a simple checkbook register or a spreadsheet. It's fast, it's easy, and it's really only good for the tiniest operations. A freelancer, maybe.
But there's a massive drawback there.
A huge one. It has zero internal checks and balances. It's incredibly easy to miss an entry, to miscalculate, and you have almost no way of spotting those errors.
So it's not scalable at all.
Not at all. As soon as a business needs to be taken seriously, for loans or investors, single entry is just inadequate.
And that's our cue to jump to the gold standard, double entry bookkeeping.
This is what almost every growing business is required to use, purely for its reliability.
And the core idea is that every transaction gets recorded in at least two accounts, a debit and a credit. Why is that specific mechanism so powerful?
Because it creates a self-correcting system. It ensures accuracy, balance, and traceability in a way single entry never could. It's the fundamental tool for preventing errors and, frankly, fraud.
Okay. And this whole system, this entire world of accounting rests on one Single, unbreakable principle.
This is it. This is the North Star. If you only remember one thing from this whole discussion, make it this equation. Assets equals liabilities plus equity.
Assets equal liabilities plus equity. Why is that the foundation of everything?
Because every single transaction a business ever makes, from buying a coffee to taking out a multi-million-dollar loan,
Yeah.
has to keep that equation in balance.
It always has to be equal.
Always. If you increase an asset on one side, you have to either increase a liability or equity on the other side, or decrease a different asset. The equality must hold.
Okay, that makes perfect logical sense in theory. But this is where people, myself included, hit a wall. The actual mechanics of debits and credits.
It can feel counterintuitive at first.
Is there a simple way for a beginner to just remember the basic direction of things?
There's a decent mnemonic device. Think about what increases with a debit. Two main things. Debits increase expenditures and assets. DEA.
Okay, DEA. Debits increase expenditures and assets.
Right. And conversely, what increases with a credit? Liabilities, equity, and revenue. LER.
LER. Okay, so DEA for debits, LER for credits. That's a helpful starting point.
It is. So now for the more dense official rules that make it all work. Debits are always on the left side of the ledger.
And a debit represents an increase in an asset or an expense, or a decrease in a liability or equity.
Correct. And credits are the opposite, on the right side. The credit means an increase in a liability, equity, or revenue, or a decrease in an asset or expense.
The key is that for every debit, there must be an equal credit somewhere else.
That's the whole game.
All right, let's make this real. Let's move from the dense rules to actual transactions. We'll run through 5 quick scenarios.
Let's do it.
Start with the most basic one, simple cash sale. You make $500 cash.
Okay. Your cash went up. Cash is an asset, so you debit cash for $500.
Yeah.
Your income or revenue also went up. Revenue increases equity, so you credit income for $500.
Asset side up, equity side up, balance.
Perfectly balanced.
Now, what's a common mistake people make here? Let's take paying an expense. You spend $200 cash on office supplies.
People get confused about which account is which. Supplies are an expense. Your expenses are increasing, so you debit the expense account.
And you paid with cash, so your cash asset is going down.
Which means you credit cash. Beginners sometimes forget that expenses act like assets. They both increase with a debit.
Okay, that's a key point. Now let's do a fixed asset. Buying a $30,000 truck with cash.
All right, you're getting a new asset, the truck. So you debit the truck account.
But you're using another asset, cash, to pay for it.
Right, so you credit cash. In this case, the net effect on the whole equation is 0. One asset goes up, another goes down by the exact same amount. The balance is maintained just on the asset side of the equation.
That's a great example. Now, same truck, but this time we finance it with a bank loan.
The mechanism just shifts a bit. You still get the truck, so you debit the truck asset account.
But instead of cash going down,
you create a loan, which is a liability. So you credit the loan account. Now, both the asset side and the liability side have increased equally. The equation stays balanced.
Perfect. Final example. Owner investment. The business owner puts $10,000 of their own, already taxed, personal money into the business bank account.
Okay, first, the business's cash asset is increasing. So we debit cash.
And this is the crucial part, right? It's not income.
Absolutely not. It is not revenue. It's an investment from the owner, which is part of equity. So you credit the owner's equity account, asset side up, equity side up, balanced again.
The big takeaway for me here is the traceability. This double entry system means you can always see where the money came from and where it went, which is how you build those accurate reports.
That is the foundation. And once
Yeah.
you've got the mechanics of debits and credits, the next step is organizing it all into a usable structure.
Which brings us to the chart of accounts, the COA.
Exactly.
The COA always sounded so bureaucratic and boring, but it's in every piece of software. It's more than just a list, isn't it?
Oh, it's way more. It's the organizational DNA for your company's finances. It's a structured list of every single account you use: assets, liabilities, equity, income, expenses.
And every single line on a P&L or a balance sheet comes from the chart of accounts.
Every single one. Its purpose is detailed analysis and accurate reporting.
And it has to be flexible. A trucking company's COA is going to look totally different from a restaurant's.
Totally. It's a living, breathing document.
Yeah.
You know, a startup might just have one account called marketing.
But that's useless once you start spending real money.
Right. As they scale, they need to break that down. They create a parent account, advertising and marketing, and then sub-accounts under it. Online advertising, print ads, pay-per-click.
And that detail is where the strategic insight comes from. You have to know if your $4,000 on Google Ads is working better than the $1,000 on print. Without the COA, it's just one big bucket.
Precisely. The COA provides that structure for analysis.
So zooming back out a bit, what's the overall process? From a receipt in your hand to a finished report.
It starts with source documents, the receipts, the invoices, the bank statements, the proof,
You have evidence.
the evidence. Then you do the recording using the double entry method we just talked about. From there, it all gets compiled in the general ledger, which is the master record of all your accounts.
And there's a critical checkpoint before you can make any final reports, right?
Yes, the trial balance. This is a report that lists all your account balances to make sure, you guessed it,
Total debits equal total credits.
it's the sanity check. If the trial balance is off, you know for a fact there's an error somewhere that you have to find. After that, you can prepare the financial statements and close the books for the period.
Okay, let's focus on income for a minute because compliance here is just non-negotiable.
100%.
Yeah.
All money earned sales, services, interest, it's all revenue and it must be reported, no exceptions,
Even if it's cash that never even touches the business bank account.
especially if it's cash. In an audit, documentation is your only defense. You need invoices, bank statements, even a detailed spreadsheet. You have to be able to prove your sales figures.
For a brand new business owner, what's the absolute bare minimum they have to track for every sale?
At its very core, the date and the amount. That's it. For compliance, those two data points are the essentials for recording revenue.
Okay. Now, let's wrap up the mechanics with a really important distinction. Cash basis versus accrual basis for recording that income.
This is a huge one, and it dramatically changes how you see your company's profit.
So what's cash basis?
It's simple. Payment and service happen at the same time. You only record income when the cash actually hits your account. You mow a lawn, they hand you $200. You debit cash, credit income. Done.
But accrual basis is different, and it's required for most larger companies.
Or any company that sends invoices. With accrual, you've provided the service, but the payment is delayed.
So how does that work? You finish a big $5,000 project and send the invoice.
Under accrual, you have earned that income the moment you sent the invoice, so you have to recognize it then.
You don't have the cash.
You debit an asset called accounts receivable, or AR. It represents the client's promise to pay you. And you credit your income account. You've now recognized the revenue, even though the cash hasn't arrived.
So that accounts receivable asset just sits on your books. What happens when the client finally pays a week later?
When the cash arrives, you debit cash for $5,000. But you do not touch the income account again. You already recorded that.
So what do you credit?
You credit accounts receivable. That entry cancels out the AR balance, showing the promise has been fulfilled and the cash is now in hand.
That is a critical distinction for any service business. Okay, we've covered a ton of ground here. We've established why bookkeeping is so important. We've dissected the accounting equation and walked through how debits and credits actually work, including that cash versus accrual difference.
And if we connect this back to the big picture, mastering these fundamentals, especially double entry, is what separates a business run on gut feelings from one run on accurate, verifiable data. It gets you out of the shoebox of receipts and into a position to get funding and actually grow.
Right. And to leave everyone with a final thought, we mentioned that the trial balance is that critical check to ensure total debits equal total credits. We know the accounting equation, assets, liabilities, plus equity, always has to balance. So if you're preparing your trial balance and you find a small imbalance, say your total debits are just $100 more than your total credits, what does that immediate disparity tell you about the kind of error you must have made somewhere in your records? That's something to mull over as you start your own deep dive. Thanks for watching. If you enjoyed this conversation, please like it, leave a comment, and share it with your friends and family. If you want to hear more conversations like this, don't forget to subscribe to our channel. We'll keep bringing you such great content. Now, see you in the next conversation. Until then, take care. Thank you.